Robert, why is it not recommended to borrow against your policy to open another policy? I don't say that. I don't know who says it's not recommended. I mean, I know there's some people out there that say that. I don't know why they say that. I am not afraid to use leverage. It's just a way to use leverage. If you look at my video where I go over using a home equity line of credit or just a line of credit to almost fully fund a policy, we call that, the video is Infinite Banking and Dynamic Banking. If you look at that video, we're basically using $13,000 of our own money, and over the course of 7 years, we turn that into $87,000 by using someone else's money the whole time, except for that very first year where we put in $13,000. That's a really good return. It's a really good return on your money. You can basically do the same thing opening up another policy. Now, for the most part, you don't want to just open up a bunch of new policies. There should be a reason for it. Oftentimes, you can expand the policy that you already have, as long as your health is still good. But sometimes it makes sense to have different policies. I like to have different policies with different carriers. It's kind of like diversifying because each carrier is going to earn different dividend rates, and it ensures that regardless of the year, I mean, the insurance companies tend to battle each other for the top dividend rate. Some pay it more one years, other pay it more in other years. So I like having that diversification, but for the most part, we're sticking with the top performers historically. And then each one offers different advantages when it comes to their policies. So let's take Guardian. Guardian is among the top 3 choices that I like. Guardian is the 3rd highest dividend paying. So if you want to see the growth within the policy, Guardian is not the best one to do. But Guardian has the most flexibility. So I write mostly Guardian policies because a lot of the folks need that flexibility in the policy in order to maximize its use. And the actual difference between the dividends is not so much that you're going to reject it just because Guardian this year has a 5.65% interest rate, and their dividend, and Penn Mutual has 6.1, and Mass Mutual has 6.2. The dividend rate doesn't make that big of a difference. It's going to make more of a difference if we can get more money into the policy and you can actually use that money. When it comes to Mass Mutual, we can put in 10x, 10 times the base premium for a lot more years than we can Guardian. But they're not as flexible. They're less flexible. So it's harder to put in large amounts because when it comes to the design of these policies, Mass Mutual and Penn Mutual, really both of those two, they want to know exactly how much we're going to put into the policies each year. I'll tell you right now, none of these insurance underwriters like the infinite banking concept. None of them like to see us put a large portion of our income through these policies. It makes them nervous. They would much rather see a policy that I design that looks like it's going to barely be funded for the next 30 years and could possibly implode because it doesn't get enough funding. They would rather see a policy like that because the low amount of premiums that's designed to pay, they're just more comfortable with you being committed to that. If I take that same exact policy and I bump it up to the maximum amount that it will actually let us fund within that policy, the underwriters suddenly get nervous and they want to reject those applications. So we kind of do a little bit of a dance and we balance out between what we ask from the insurance company and what you're able to do. If you have plenty of income, if you have a lot more income than you're wanting to put in a policy, it's pretty easy to get that into Mass Mutual or Penn Mutual. But if you don't, if you're really trying to do a high percentage of your income, we want to go to Guardian. It's a lot easier to get a policy approved because of the flexibility. Or we may look at an IUL. An IUL has a ton of flexibility with regards to how much you can put in compared to the minimum funding and the maximum funding. And the IUL is also referred to as like the rich man's Roth. It's a great alternative to money that you might otherwise put into the stock market. You're not going to have the same type of returns that you would get out of the stock market, but it's protected. There's a lot of safety that comes along with it. And you do have some potential growth that could really be breakout. With the company that I like for maximizing potential growth, that would be Allianz. And with the specific index options, if you had been in that index option for the last 10 years, you could have earned 14% a year. That's solid, along with the guarantee that you're not actually going to lose money in the marketplace. The only thing is there's insurance costs, and those insurance costs are minimal. So each year, even if there was no growth in the stock market, the only thing that's going to bring your value down would be that cost of insurance. And we minimize those insurance costs in every design that we do. So those can be a good option. A lot of different ways that we can go with this, but it's my job to figure out what your situation is and which one's going to work best for you. Okay, which one is going to help you meet your goals? I'm not going to tell you what your goals are. You're going to tell me what your goals are, and I will say, I'll make some recommendations. This is good for this. This is good for this. And I'm still putting out videos for all of these companies. I don't have different ones, so you may not yet be able to find all that information out for yourself, but I hope that soon you will be able to. My goal is to put out enough videos on this channel that if you want to do all the research yourself, you can do that. You don't actually have to call me to figure this stuff out. You don't have to call another agent to figure this stuff out. You're going to know what a good policy looks like. I've already put a bunch of those videos out so that you can identify what a good policy looks like. So even if you don't want to work with me, let's say you have a relative who's an insurance agent and you want them to sell you the policy, they can watch the video and see what's expected from a design point, because it comes down to design. Almost all of it comes down to making sure that you get the proper design. You really need to have a good company. I mean, that's kind of a given. You got to have the right company. You got to have the right product within the right company, and then that product has to be designed. I can take the best product in the best company, and I can design it to benefit me and not you, and that policy is going to perform like crap. But I could probably design it so that you kind of like it, because a lot of insurance agents do that. Although I'm really bad at that. I tried it the other day. I was trying to match somebody else's really poorly designed policy. I couldn't even do it. I don't know how to design them as bad as that person had got from somebody else. It was pretty funny. So I gave up on trying to match the poorly designed one. But just know that there are some pretty poorly designed policies out there that will not serve you. And some of these agents don't even know it. They don't even know that their policies can be designed better. Talked to an agent the other day. They're doing, what is it that they were trying to sell? It's from one of the major insurance companies, one of the major IMOs, insurance marketing organizations, that sells the most policies that I'm aware of a particular insurance company. They don't work for that company. They don't work for that insurance company, but they sell those products, and they sell more of them than anyone else I know. They did not train this agent on how to design a policy the way that I design these policies. Not even close. They didn't even hint at it. So this agent watched one of my videos and didn't know how to design the policy even after watching how I did it, because he was missing one key part. And that key part basically boils down to how these insurance companies sell their products. And that part was target premium. This is an IUL that I'm talking about, and target premium determines how much the insurance agents, and in turn how much their bosses and those IMO companies, it determines how much they get paid. And so those agents are getting trained to focus on target premium. They want that target premium to be as high as possible. They want to design a policy all around that target premium. So when he looked at my design and he tried to design the policy to match it, it wasn't anywhere close. And he didn't know why. But the reason that the whole design was falling apart was because he was taught to go right to target premium, and that's what you do. That's how you design it. You got to design it for target premium. That's how they score their points. That's how they're rated according to their bosses, is they get points based on target premium. And so everybody in that company And some of these people sell 20 policies a day. Everyone in that company gets rated on target premium. With the policy that he was designing, the target premium was like $4,000 or $5,000 on I think it was like 12 or 15,000 a year premium. Okay. When it comes to IULs, an agent makes anywhere between, well, it depends on the company you're with. Some of them are really bad. Some of them only give you a 30% commission because the rest of that's split between others up above. But a regular agent who's not in a multi-level scheming company, you can make 95 to 115% of that first year's commission. That's what we would get paid on that. And it's based on that target premium. So with his design, he was looking at a $3,000 to $5,000 commission on a $12,000 to $15,000, can't remember the exact numbers, but $12,000 to $15,000 annual premium. I showed him how to get around that. And what happens is when you don't go for target premium, you go for cash value design for the client. First year cash value on his design for that policy was like $0 or close to zero. When we redesigned it, the cash value in that first year, I really wish I remembered what the values were. If it was $15,000, the cash value would have probably been, the accumulated value would be really close to $15,000, probably $14,000 and change, and the cash value would be just a little bit below that, maybe $11,000 or $12,000, because there's surrender charges within the policy. So first year's cash value for you, the client, goes from $0 to $1,000 all the way up to $10,000 or $11,000. And long term, when we play that out to get an income stream in retirement, the difference is probably $4,000 a year on that. When I, as an agent, get paid $4,000 extra that very first year in my commission because of how I designed that policy, it's going to impact your income stream in retirement by $4,000 a year. It reduces it. So that's a really big deal, in my opinion. Now, I'm going to defend them a little bit. Well, I'm going to defend those agents that work for that company a little bit. One, they're not trained properly to design these types of policies. Okay? They're trained to make money for them and the insurance company. And if they try to design it differently, they will likely get fired because they're not going to meet the numbers. Remember, they get scored based on target premium. And so they're competing with other agents in that office to hit target premium numbers. So this company can just shuffle that person out and fill that seat with another body. That's their business model. Even designing these policies as badly as they do, they sell a ton of them because as a product, these products are really good. The IULs are really good. So even if you don't have good cash value in the early years, you may not need that. I imagine the people that are buying these, they don't really need that. They're not being sold that they could use it better or that it can be designed better. And they're probably pretty happy with it because the numbers that end up are still really good. They're still really good numbers in 30 years. Now, that's going to depend on the stock market performing. Part of the big problem with how they design it and who they sell these to is those people often underfund these policies or they get rid of them during the surrender charge period. And with the way these policies are designed, they're out a whole lot of money. If they put $15,000 in that first year and the next year their income dries up, they don't have any ideas on how to make those premium payments. Like I teach you guys how to make premium payments, how to get up to the MEC by diverting expenses. These people don't know that. They come up with a stumbling block. They don't know how to make their premium payment, and now they cancel the policy. They're out $15,000. You start a policy with me, your cash value is $11,000 that first year. If for some reason the next year everything goes to crap and you don't want to continue it, the policy will fund itself for a few years, first of all. But if you wanted to cancel the policy, you're out $4,000 instead of $15,000. So upside is a lot better. Worst case scenario, a lot better. So all comes down to policy design. Just remember that. Hopefully it provided you guys with some value there. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below. or join us on one of our Wealthcare Wednesday live streams where you can ask the question and we'll answer it on the air live. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.